Welcome to Sophie Daddy's channel. On October 10th, 2025, after a long period of calm, the market got a massive shock. It wasn't a bank failure or a health crisis. It was the U.S. China trade war, and it was back with a vengeance. So in this explainer, we're going to break down what happened, what makes this new conflict so different, and most importantly, what it means for you as an investor.
So let's start with the number that sent shivers down Wall Street's spine, negative 2.7%. That's how much the S&P 500 dropped in a single day, its worst performance in 6 months. Just like that, weeks of gains were gone in a matter of hours. A pretty brutal end to all that optimism, right?
So, how do we make sense of all this? Well, here's our game plan. First, we'll set the scene and relive that shock. Then, we'll dive into what makes this trade war a whole new beast. After that, we'll look at the anatomy of the sell-off, see what lessons we can learn from history, and finally, we'll wrap up with a disciplined investor playbook to help you navigate all this volatility. To really feel the impact of October 10th, you kind of have to understand the mood right before it happened. I mean, the markets were at all-time highs, just basking in this glow that everyone was calling AI-driven euphoria. The S&P 500 had just set a new record, and get this, not even a U.S. government shutdown could really shake that optimism. And it was right into this picture-perfect calm that the trade war bombshell just exploded.
But here's the thing. This isn't just a repeat of the 2018 trade war. Oh no. The tactics have evolved. They've gotten smarter. So let's look at the first shot fired by the U.S. that triggered everything, and then we'll break down China's response, which was much more calculated and honestly pretty strategic.
And here it is, the catalyst. A single social media post from former President Trump. It threatened a massive increase of tariffs, but the real bombshell was canceling that planned meeting with President Xi. You see, this wasn't just an economic threat anymore. It was a diplomatic slap in the face. It basically took away the main path to calming things down, and the market absolutely panicked. And this is where things get really interesting. You can see a huge contrast in strategy. The U.S. came in with a blunt instrument, right? The threat of broad tariffs across the board. China's response was completely different. Think of it more like a series of surgical strikes. They targeted very specific things, controlling rare earth technology, launching antitrust investigations into certain U.S. companies, and even adding new port fees. It's just a much more targeted and strategic way of fighting back. And this is a really big deal. China started using a tactic straight out of the U.S. playbook. It's called the Foreign Direct Product Rule. What it means, basically, is that China can now control the export of products made in other countries, as long as those products were made using Chinese rare earth technology. This is a massive escalation, and it shows that Beijing is ready to use these same powerful economic weapons that Washington has been using. Okay, so we've set the stage. We know what happened. But what did all this escalation actually do to the markets? Let's break down the damage sector by sector and see where investors decided to run and hide. Let's start with the headline number. The S&P 500, which is kind of the benchmark for the whole U.S. market, dropped a very steep 2.7%. And the tech-heavy NASDAQ? It fell right in lockstep, also down 2.7%. That told us right away that investors knew the tech sector, with all its global supply chains, was right on the front lines of this fight. But the real epicenter of the earthquake, the place that got hit the hardest, was one specific sector. The semiconductor index just plummeted, a staggering 4.1%. I mean, for the chip industry, this wasn't just a sell-off. It was a complete rout. This chart really puts it all in perspective. You can just see how much harder the semiconductor sector was hammered. So why the huge panic there? Well, it's because that industry is so deeply tangled up in the U.S. China supply chain. See, a tariff is a cost you can manage, but an export ban on a critical material, that threatens your ability to make your product at all. That's the existential risk the market was suddenly pricing in. But you know what's funny? Not everything went down in a classic flight to safety. Investors just piled into gold and U.S. bonds. And a really fascinating little opportunity popped up. With China threatening to restrict rare earth exports, U.S.-based producers like MP Materials and USA Rare Earths saw their stocks surge. It was a clear countermove driven entirely by the day's news. Okay, so now that we get the immediate shock, let's pull the camera back and look at the bigger picture. History provides some incredible context for moments like these, and it often tells a different story than you might expect. To really understand what's happening now, we have to compare it to the last time we went through this. Back in the 2018 trade war, both the U.S. and China had strong, growing economies. But today, in 2025, the picture is pretty different. The U.S. economy is holding up, but China is facing deflationary pressure. That's a huge sign of economic weakness, and that fragility is a critical new variable. And what about recoveries? Well, history shows us that while these geopolitical shocks cause sharp, painful drops, the market has a remarkable track record of bouncing back. I mean, look at this. After the September 11th attacks, the market hit its bottom in just 11 days and was fully recovered in 31. The key takeaway here is that these events are tests, not a permanent death sentence for a bull market. This timeline makes that data even clearer. But notice the outlier, Iraq's invasion of Kuwait. That took 189 days to recover. Why so long? Because it was an economic shock that threatened global oil supplies. The current trade war is also an economic shock, which suggests the recovery might be tied more to policy and diplomacy rather than just a quick rebound. So, this all brings us to the most important parts. What do you actually do now? This final section is all about strategy, a disciplined playbook for getting through this turmoil without making emotional mistakes. Right now, there are two completely different stories battling it out in the market. The bulls are saying, hey, this is just geopolitical noise. It's a great buying opportunity. But the bears are arguing that this is the start of something much bigger, a great decoupling between the U.S. and China that could cause a lasting downturn. So instead of trying to guess who's right, a disciplined strategy is always the smarter approach. And here it is, that disciplined strategy broken down into 6 clear steps. It all starts with the most important rule of all. Fight the urge to panic sell. History shows us that selling into fear is almost always a mistake. Instead, take a breath and reaffirm your long-term plan. From there, you can use smart strategies like dollar-cost averaging, make sure you're truly diversified, and maybe even look for high-quality companies that have been unfairly punished. And finally, you might consider tax loss harvesting to create a little silver lining. And that leaves us with the central question, the one that's going to define the market for the foreseeable future. Was October 10th just another bump in the road, another shock that the market will eventually absorb and move on from? Or was it the first major shot in a long-term economic realignment, the true beginning of a great decoupling between the world's 2 biggest economies? Only time will tell.
All right, the learning doesn't have to stop here. If you want to explore even more, I've built the perfect place for you at sophie-ai-finance.com to unlock a new way of learning. Think of it as your personal learning toolkit. If you just want the big picture, you can watch the video or listen to the podcast. It's perfect for getting the main concepts down while you're on the go. But if sometimes you need to hit the pause button and really let an idea sink in, you can visit the blog article. It has all the details, charts, and text from our discussion so you can review everything at your own pace. And for those of you who want to see all the math, data, and the complete nitty-gritty behind the analysis, well, I've got a full research paper waiting for you, so you can really dig into the details and see how everything works under the hood. It's all there, all for you. And hey, if you have any ideas for new topics about finance and AI you'd like me to cover, please leave me a message. Thanks for tuning in, and I'll see you in the next video.